Matt Brady here, your Carolina mortgage coach, and I want to make this quick video for you today to go over the pre-approval process, why it's so important. It needs to be the first step in your home buying process, and the difference between a pre-qualification and a pre-approval. So a pre-approval is going to allow us to determine how much house you can afford, what your monthly payment will look like, and your possible loan programs available to you. And the reason why you don't want to start the home buying process before you do this is you don't want to find a house, fall in love, and then find out it doesn't hit your budget. So the first step in the process is getting pre-qualified, and this is done through submitting an application. Basically, we're going to look at the information in your application, determine how much house you can afford, and what your monthly payment will be just based on that information. But in this market, you definitely need to get pre-approved. So that means you take the next step and you submit documentation such as your W-2s, possibly your tax returns if you're a business owner, last 30-day of pay stubs, most recent 2-month bank statements, and myself or someone on my team will review that information and make sure everything's in line, checks all the boxes, so we can make sure we're putting you in the right situation for your home buying process. The next step we can do is take it even a step further, make you an even stronger buyer, and have the underwriter review your credit, your income, and your assets. So now let's determine how we come up with the pre-approval. So what we're going to look over in a little bit deeper view is your CIA, so your credit, your income, and your assets. In regards to your credit, we're going to review your credit to make sure you meet the minimum score requirements. Each loan has its different requirements, so we're going to make sure that's met. And we're going to confirm all the debt obligations showing on your credit report. From there, we're going to review your income, look at your employment history, and determine the qualifiable monthly income for your debt to income ratio, and we'll go into that on the next slide. And we're also going to look at your assets and review them to make sure that you have enough funds available for your down payment, closing costs, escrow, and possibly if we need to show any reserves. So your debt to income ratio is determined by your total monthly debt obligations compared to your gross income. So that's before any taxes or deductions are taken out. A good rule of thumb is for this to be a maximum of about 50%. So for example, if you're a buyer and you make $60,000 a year, you earn about $5,000 a month. 50% of that will be $2,500. So that means that your total monthly payments for all debts on your credit report, including your cars, credit cards, student loans, personal loans, plus your new mortgage, cannot exceed $2,500. Now this is just the first step in the loan process, like you can see in this mortgage roadmap here. You start with getting your application in, getting pre-approved, and supplying the documentation. Then you can do the fun stuff of home shopping, and then you can see the other steps in the process. Once you find that house and get under contract, we'll go over that in other videos. I just want to quickly get this out to you, why you need to get pre-approved, why it should be the first step in your home buying process. We'll talk to you soon. Bye.